Welcome back to another week of our weekly market update video. This week is a little unique as most of us here in DFW are stuck in a winter wonderland. Uh, Rest assured, everybody is still working hard for you behind the scenes. If you need anything, don't hesitate to call in. But let's get this video started. This is going to be an important week. We talked last week about the political tension between President Trump and the central bank or the Fed. In recent weeks, President Trump has opened a criminal investigation against Fed Chair Powell over his Senate testimony about the renovations of the central bank's headquarters. This week, the Fed is in the spotlight again, but this time it's over potential rate cuts. It's important to remember that when policy, politics, and a leadership transition in the Fed are all taking place at once, the headlines can often feel louder than the fundamentals actually are. So, what do we expect to happen? The Fed cut rates 3 times in 2025, and the Fed is widely expected to pause rate cuts this week, what we call a hawkish pause. That means that rates will likely remain in the 3.5 to 3.75% range, while the Fed evaluates the impact of what they've already done. So, why pause now? Inflation has cooled quite a bit from its all time high, but it's still hovering around 2.8%, which is well above the Fed's long term target of 2%. At the same time, the labor market has softened. I was reading a headline this morning on Yahoo Finance. Amazon's cut another 16,000 jobs, which is scary. You're seeing more and more companies cutting jobs, but the system isn't broken yet. So the Fed's mindset right now isn't necessarily urgency, it's kind of digestion, right? It's trying to take all these data points and just figure out what's coming down the road. So think of it this way: monetary policy works with a delay. The Fed isn't reacting to last month's data, they're positioning for what the economy looks like 6 to 12 months from now. There's also a leadership element worth understanding. Fed Chair Jerome Powell's term expires in May of this year. We're now in what we effectively call the transition period. Now, historically, when Fed leadership changes, the Fed tends to prioritize stability, predictability, and institutional credibility over big, bold moves. That's important because stability is usually good for long-term investors. So what we're seeing right now is what we call a K-shaped economy. Higher income households remain relatively strong, while lower income consumers are still feeling the lagged effects of earlier high interest rates. This is why broad, one-size-fits-all economic commentary can often be misleading, and why we think personalized planning matters more than ever. Now, there's a potential fiscal catalyst ahead that's going to make our predictions on rate cuts even more complex. New tax policies and larger than expected tax refunds could add liquidity to the economy. That could complicate inflation in the second quarter because there's now more money in the system, which is another reason why the Fed might be kind of choosing patience right now. From a planning standpoint, this is a really important time. As rates stabilize, the really attractive yields in cash and money markets and short term instruments that we've gotten used to are starting to become a little bit less attractive. This introduces what we call reinvestment risk, the risk that today's CDs or money markets will mature and tomorrow's rates will be lower. That's why we're always actively evaluating and reevaluating the balance between fixed income and longer term positioning, things like equities. So, what's the bottom line? This Fed meeting isn't about fear, it's about patience. It reinforces why we don't chase headlines and why we manage your risk intentionally and why having a disciplined plan matters, especially during noisy moments like we're experiencing right now. As always, we're watching this closely for you, so you don't need to worry about it. If you do have any concerns, as always, give your advisor a call or give me a call. I can be reached at 214-800-4442. I want to take this opportunity to thank you for your time today. Again, if you ever need anything, you know where to find us. Thank you for your business and look forward to seeing you next week.